After Chinese authorities pressured Didi to delist from the New York Stock Exchange, many analysts feared that this is the beginning of the end of Chinese stocks in US exchanges. Some analysts went as far as saying Chinese stocks are uninvestable. Hey guys, this is Muhab, and today we'll explore the severity and probability of Chinese stocks being delisted from US exchanges. This is going to be a 2-video series. In this video, we'll explore the risks from the Chinese side, and in the second video, we'll explore the risks from the US side. As always, before I start, make sure to click the like button, subscribe for more videos, and if you want to have a look at my stocks portfolio, I'll leave a link to it in the description below. Now let's roll the intro and start the video. Before we start exploring the risks, we must first understand how Chinese companies list themselves in US exchanges, because it is not the same as companies from the US or other countries. After understanding that, we can then easily explore and understand the risks imposed, in addition to the chance of the risk actually materializing. China does not allow foreign ownership in many of its sectors. Some of these sectors are automotive, telecommunications, and the internet, just to name a few. China considers these sectors and many others as sensitive, and so they don't allow foreign investments in them. In fact, this is the reason why companies like Alibaba, Tencent, and Baidu are not listed in Shanghai Stock Exchange, because it's simply illegal. In fact, Alibaba wrote down in their IPO filing back in 2014, quote, "Although not currently allowed under People's Republic of China's law, rules, and regulations, we may conduct a public offering and listing of our shares on a stock exchange in China in the future," end quote. But obviously they won't be doing that anytime soon because it is still illegal. Well, so we're in a situation where international investors want to get access to these companies due to their economic growth and profit generation, and Chinese firms want to access that capital to raise money. Even if some of the Chinese companies don't want that capital, being listed in a respected exchange like the New York Stock Exchange or the Nasdaq result in an improved branding, provides greater level of liquidity to buy and sell shares, and provides a level of prestige to the company too. So it sounds like a win-win situation. As a result, financial engineers found a solution to bypass that law that prohibits foreign ownership in these companies. The restrictions of foreign ownership are circumvented by a structure called variable interest entities, or VIE for short, whereby the economic benefits of a corporation are passed along to a third party via a series of contracts. Sounds confusing? Let me simplify. For a company like Alibaba to go public, they would first need to create a shell company in the Cayman Islands, or in any other country, but they usually prefer the Cayman Islands for tax reasons and for many other reasons. But anyways, then the real Alibaba makes a complicated contract with the shell company it just created to give it the right to claim profits and control the assets of the real company. This contract is the VIE contract. Finally, the shell company that was just created with this VIE contract is the company that actually goes public. In other words, Alibaba stock we own from the New York Stock Exchange is a shell company in the Cayman Islands with a contract that claims profits and control of assets of the real company. This is how SoftBank and Yahoo use this structure to exercise their quote-unquote ownership over the majority of Alibaba, but in reality, they don't own the real Alibaba. As a result, people who invest in Chinese companies don't have the level of rights and protection as those who invest, for instance, in American companies. Now, the VIE structure is also illegal, and the Chinese government could easily prohibit that agreement, making the investments in these shell companies worthless. In fact, there are stories where China ruled against the VIE structure of some companies and deemed it as illegal. China Chem was a foreign company that wanted to invest in the Chinese Minsheng Bank, but the Chinese law prohibits foreign investors from acquiring equity stakes in financial institutions. It's a bit funny given the foreign company has China in its name, but it still cannot invest in Chinese financial institutions. But anyways, what it did, it entrusted a Chinese company called China Small and Medium Enterprise Investments to invest in Minsheng Bank on its behalf, but under the Chinese firm. At some point, the Chinese firm refused to pay China Chem the dividends from Minsheng Bank. So what China Chem did, it sued it in the courts. The Supreme People's Court's final judgment was that China Chem was circumventing the law and declared that the investment agreement between China Chem and China Small and Medium Enterprise Investment was invalid. In other words, they lost all of their investment. However, even though the agreement was considered invalid, that does not mean all VIE structures for all companies were banned. That's because of the way the law works in China. If China decides to ban all VIE structures, that means our investment will be in a worthless shell company in the Cayman Islands that happened to have the same name as the company in China. And the shell company just became worthless because it lost that VIE contract that gives it the economic benefits like profits and assets of the real company in China. That includes both companies listed in US exchanges and also in Hong Kong exchanges too. Remember, it's illegal to list the actual company in Shanghai, let alone Hong Kong. So we still have that shell company that is being listed in both Hong Kong and in the US. Now, as scary as all of that sounds, banning the VIE structure rarely happens. In fact, I believe China Chem's example is the only time China went as far as bluntly banning the VIE contracts between two companies. Also, the ban happened because the Chinese company was not paying the dividends to China Chem, resulting in lawsuits rather than China banning the VIE structure between both companies out of nowhere. Also, it's important to stress that the VIE structure was between two companies that have different management. This is not the case with, for example, the Chinese Alibaba and Alibaba Shell Company. In reality, China is more accepting of the VIE structure than you may think. It mostly turns a blind eye when it comes to it, even though it's illegal. In fact, when Didi was forced to be delisted from the New York Stock Exchange after being pressured from the Chinese authorities, many US media outlets claimed that this is the end of Chinese stocks and all of them will be forced to delist. However, the Chinese Security Regulatory Commission, or the CSRC in short, released a statement in December of 2021 stating that, quote, "Recently, some overseas media reported that Chinese regulators will ban overseas listing of companies with VIE structure and demand Chinese companies to delist from US exchanges, which is a complete misunderstanding and misinterpretations. As far as we know, some domestic companies are actively communicating with domestic and foreign regulators to seek a list in the US markets." End quote. In other words, it bluntly said that there are no plans to ban the VIE structure. Well, how about what happened with Didi? Even though it didn't ban the VIE structure, it forced it to delist. Could this happen to other Chinese stocks? Or maybe to our Alibaba investment? Well, let's explore that case. Didi was under Chinese authorities' pressure because it didn't respect the authorities' position when it asked Didi to delay the IPO due to fear of confidential data leakage. Also, a day after the IPO, the Cyberspace Administration of China found serious violations in how Didi collected and used personal information. On the other hand, a company like Alibaba is not in any confrontation with the Chinese authorities. Even after they were fined $2.78 billion after the antitrust investigation, Alibaba accepted the fine with sincerity, and the company intends to invest $15.5 billion in the Common Prosperity Initiative over the next 4 years, showing its support to the authorities. Also, even though China demonstrated that it's willing to sacrifice its economic growth and foreign investments for its economic stability as we saw in 2021, I don't think it'll reach a point where it'll shoot itself in the leg by banning VIE structures and delisting $2 trillion worth of companies in the US markets. This is because the US is one of China's largest trading partners, and China is the largest foreign owner of US debt. By delisting all of the Chinese stocks and banning the VIE structure, then China is pretty much losing all of the US market. However, China could still do what it did to Didi, but with other Chinese companies. It could force them to delist from US exchanges for any reason, maybe because of escalations in the US-China feud, or it might be because of data privacy reasons, or maybe they want all Chinese companies to only list in Hong Kong so China can limit what information they have to share with the US. Whatever the reason, if this happened, then I'm sure the value of the stock will fall in the short term. However, for companies like Alibaba, who also have a listing in Hong Kong, it shouldn't be a problem as you can still trade it there. Sure, it will lose a major exchange, but it won't reach a point where you can't trade it in an exchange. Even if the company is not listed in Hong Kong Stock Exchange, it can still be traded over the counter where the stock is sold directly without the supervision of a stock exchange, but this will heavily limit the liquidity and not all brokers offer that. Personally, I have 3 Chinese companies in my portfolio: Alibaba, JD, and Douyu. The only company that is not listed in Hong Kong out of these is Douyu, and I'm sure if China decided to delist all of its companies from the US, then Douyu would IPO in Hong Kong. In summary, the biggest risk shareholders of Chinese companies are facing from China is the delisting of these companies from the US markets. This can happen either by banning the VIE structure or by pressuring them to delist from the US market. Let's pull up a table rating the severity and probability of this risk happening and rate them from 1 to 5. Let's start with China banning the VIE structure. By doing this, the Chinese stocks in international exchanges will be pretty much worthless, so I'd say the severity of that is 5 out of 5. However, I would say the probability of this happening is 1 out of 5, not only because China bluntly said it's not considering that, but also because it will affect the Chinese economy heavily in a bad way, and I'm sure China does not want that. When it comes to forcing companies to delist from US exchanges, I think the severity of that is 3 out of 5, because if you're investing in a large Chinese company, it's most likely listed in Hong Kong, so you can easily trade it there. And if it's not listed there, then most likely it's going to list there once China starts forcing companies to delist from US exchanges. And sure, the investment will probably heavily drop due to loss of liquidity from US exchanges, but it won't be the end of the world. The probability of this happening, in my opinion, is 2 out of 10. This is slightly higher probability due to the feud between the US and China that has been going for some time, and delisting all stocks from US exchanges might be used as leverage. However, I still think it's unlikely to happen, but more likely to happen than banning the VIE structure. In short, I don't think China will plan on delisting all Chinese stocks anytime soon. As a result, I will personally continue holding my investments in Chinese companies. In the next video, I'm going to explore the risk on Chinese companies from the US side, which I actually believe is a more significant risk than the one from the Chinese side. So stay tuned. For now, this is the end of the video. Please don't forget to like, share and subscribe. Thank you for watching. This is Muhab and I am signing out.